Picture this. It's 2026. You wake up, grab your phone, and your feed is just a wall of panic. Markets halted, banks in temporary trouble. Everyone suddenly pretending they knew this was coming. And you're sitting there thinking, wait, did we seriously just do 1929 and 2008 all over again? Because here's the twist. The warning sign wasn't hidden, it wasn't classified, it wasn't even complicated. It was right there, in a boring, squiggly line called the yield curve that almost nobody outside finance ever looks at. And that line, for decades, has had this freaky habit of screaming recession incoming and being right way more often than it has any business being. 1929, 2008. Is 2026 next? Stick with me, because once you see the pattern, you won't be able to unsee it, and you'll also notice how many people are just choosing not to look. Let's start simple. What even is this yield curve thing, and why do supposedly smart people obsess over it? Think of it as a snapshot of how expensive money is, depending on how long you want to borrow it. Governments issue bonds. You lend them money, they pay you interest. Short-term bonds are like a 3-month loan. Long-term bonds are like a 10-year or 30-year loan. The yield curve is just, on the left, very short loans, on the right, long loans, and we plot the interest rates. That's it. In a normal, calm world, this curve slopes up. Why? Because if I'm going to lock up my money for 10 years instead of 6 months, I want more reward, more time, more risk, more return. Totally intuitive. Now here's where things get weird. Sometimes the curve flips. Suddenly, short-term interest rates are higher than long-term ones. The line bends downward. That's called an inverted yield curve. And whenever that happens, people who pay attention to this stuff sit up straight, because historically, that flip has been one of the most reliable indicators before recessions. Not the cause, but the warning light on the dashboard. And like most warning lights, it usually gets ignored right up until smoke starts coming out of the engine. Let's rewind all the way back to 1929, the roaring 20s. Jazz, flappers, stock market euphoria, the whole "this time prosperity is permanent" vibe. On the surface, things looked unstoppable. Underneath, credit was getting tighter, speculation was going insane, and short-term money was getting more and more expensive. Long-term investors, meanwhile, were quietly accepting lower yields because they weren't convinced the party would last. Sound familiar? It's like everyone in the VIP section saying, "We're fine," while the fire alarm in the hallway is just blaring. Most people back then didn't think in terms of yield curves, but the dynamics were the same. Short money screaming stress, long money whispering doubt. That mismatch between the story and the structure always matters. And in 1929, we found out the hard way. Jump forward to the mid-2000s. Different era, same arrogance. This time it's housing. You can't lose money in real estate. Banks have new models. We've tamed the business cycle. You know, the usual greatest hits. Underneath that confidence, the yield curve did its old trick again. Short-term rates climbed above long-term ones. It was like the bond market was saying, yo, the future doesn't look so hot. People are going to need lower rates later because something is going to break. In other words, the market was pricing in a slowdown, even while everyone on TV was still selling the dream. Then, surprise, surprise, the housing bubble burst, the banking system freaked out, and 2008 became a year that everyone still winces at. Now, here's the important bit. In both of those eras, the inversion didn't cause the crash. It was more like a symptom of deeper tensions. When short-term rates are high, it means money right now is tight, or the central bank is slamming the brakes to fight inflation or cool things down. When long-term rates are low, it means investors are looking at the future and saying, we don't see growth, we don't see inflation, we see trouble. Combine those two and you get a weird contradiction. The present is expensive, the future looks cheap, and the financial system that lives in the middle, banks, lenders, businesses, starts to feel like it's walking on a tightrope. And banks, by the way, absolutely hate inverted yield curves. Their entire business model is basically borrow short, lend long, take deposits and short-term funding on one side, hand out longer-term loans on the other, and earn the spread in between. When the curve is normal, this is like a gentle downhill slope. They can roll along and pick up a margin. When it inverts, the hill flips. It's like trying to make a profit cycling uphill in the rain while someone throws rocks at you. That's when lending standards tighten, people get cautious, and the real economy starts to feel it. Now, fast forward again. to the 2020s. We've had a pandemic. We've had massive money printing. We've had inflation spike after everyone spent years saying it was dead forever. Central banks slammed on the brakes with rapid rate hikes. Once again, the yield curve, especially those key parts that compare short-term rates to 10-year bonds, flipped upside down. Not briefly, for a while. Whenever that happens, the arguments begin. One camp says, relax, this time is different. The world has changed. The other camp says, the yield curve has called so many recessions, you'd be crazy to ignore it now. Somewhere in the middle, regular people are just trying to pay their rent. So why are people specifically whispering about 2026? Because the yield curve doesn't work like a fire alarm where the disaster hits tomorrow. Historically, there's a lag. It inverts, then months go by, sometimes over a year, where everything seems fine. The market might even hit new highs. Politicians claim victory. Everyone mocks the doomers. But under the surface, the system is absorbing those higher short-term rates. Companies are refinancing debt at worse terms. Households are stretching themselves thinner. Governments are rolling over bonds at a bigger cost. And then, gradually, something gives way. Unemployment ticks up. Credit defaults rise. Spending slows. Suddenly, the same people who said no recession start saying soft landing, and then quietly transition to unexpected headwinds. If you map out past cycles, you'll see this sort of rhythm. Inversion first, recession later. Not always, not perfectly, but enough that ignoring it entirely is brave, let's say. So, if the curve inverted earlier in the decade and stays weird for long enough, people start placing their mental bets on a window a couple of years out. And 2026 sits right in that. If it's going to show up, it tends to show up around now window that makes a lot of macro nerds nervous. Now, before this starts sounding like pure doom porn, let's be fair. There are false alarms, or at least soft outcomes. Sometimes the curve inverts. Everyone gets scared, central banks adjust, fiscal policy shifts, and the end result is more like a slowdown than a biblical crash. The tricky part is, you only know which one you got in hindsight. In real time, it always feels the same. The curve inverts, the commentators argue, the data sends mixed signals. Half the people are screaming recession, half are screaming resilient economy, and the rest are mute because they got fired in the last downturn and decided to touch grass instead. So where does that leave you? You, watching this, probably aren't a bond trader. You're not running a central bank, and you're not writing a PhD thesis on yield curves. You just want to understand, is this pattern real, and does it matter for my life, my job, my savings? Let's strip away the jargon and focus on what the yield curve is really capturing: collective expectations. It's the sum of millions of decisions about fear and greed stretched across time. When short-term rates are high, that's the present tense saying, we're fighting a battle. When long-term rates are low, that's the future tense saying, we might not win it cleanly. The inversion is where those two sentences collide. The controversial part is not that the yield curve has a good track record. That's pretty widely acknowledged in professional circles. The controversial part is how aggressively people are willing to ignore it whenever the narrative of the moment feels more comforting. In the late 1920s, the narrative was permanent prosperity. In the mid-2000s, it was financial innovation and ever-rising home prices. In the 2020s, it's strong consumer, resilient labor market, AI boom, we can handle higher rates. And look, some of that might be true. Innovation is real, productivity can improve. But the yield curve isn't asking, is there cool new tech? It's asking, can the entire system handle the cost of money staying like this without breaking something important? Here's a useful way to think about it. Imagine the economy as someone running on a treadmill with a backpack. Every time we raise short-term rates, we quietly add a brick to the backpack. At first, they feel great. Strong legs, good stamina. See, I told you I could handle this pace. The yield curve inverting is like the moment when the trainer at the gym walks in, looks at the speed and the weight, and says, yeah, they can't keep this up. They're not slowing down yet, but they will. The runner may even speed up for a bit, but time always wins that argument. So when people say, 1929, 2008, 2026 next, what they're really doing is drawing a line through history where we have repeated one pattern over and over again. Ignore the structural warning signs as long as prices keep going up. You'd think we'd learn. But remember, the people making decisions at the top are under incredible pressure to believe in good outcomes. CEOs don't get bonuses for saying, we're going to be cautious and maybe earn less. Politicians don't win elections by saying, we might have a recession soon, let's slow things down. Fund managers don't attract clients by saying, we're just going to sit and wait for the storm. There's huge career risk in being early, in being the person who pulls back before the party stops. That's why, again and again, the yield curve turns into a kind of morality test. Are you willing to listen to an unglamorous, data-driven warning that doesn't tell you when, doesn't tell you how, but very calmly says, the odds of pain just went up? Or do you keep maxing out the leverage and hoping you'll be one of the people who gets out in time? History suggests that a lot of very smart people choose the second option and then act shocked when it ends badly. Now, I want to make something super clear here. This is not a script about telling you to panic, to sell everything, or to go live in a cabin in the woods stacking canned beans. That's not useful, and I'm not giving you financial advice. What I'm saying is this. If you want to be less blind than the average person walking into whatever the mid-2020s throws at us, you should at least understand what the yield curve is whispering. And then you combine that with other things: job market trends, corporate earnings, debt levels, geopolitical risk, your own personal situation. The yield curve is just one powerful piece of a larger puzzle. So how do you use this knowledge in a practical way without obsessing over it every day? First, you internalize the pattern. When the curve inverts, the story is not crash tomorrow. It's window of elevated risk over the next couple of years. That's your mental model. Second, you watch how everyone responds to it. Do central banks adjust their tone? Do governments start pumping out stimulus? Do companies start issuing warnings or quietly laying people off? The inversion is the match. The real world decides whether it lands in a forest or on a concrete floor. Third, and this might be the most important, don't immediately trust anyone whose entire argument is this time is completely different or the old rules don't apply. Maybe they don't apply perfectly. The world changes. But patterns this persistent don't just evaporate, they evolve. Think of it like weather forecasting. If every time a certain pressure pattern showed up, there was a big storm within a week, you wouldn't say, well, we've invented better umbrellas now, so storms are canceled. You'd say, okay, we might have better tools to handle it, but yeah, I'm still bringing a jacket. So is 2026 going to be another 1929 or 2008? Probably not in the copy-paste sense. History doesn't usually give us exact repeats, it gives us remixes. 1929 was about uncontrolled speculation and a fragile gold standard world. 2008 was about housing, derivatives, and a banking system that pretended risk had disappeared. The next crisis, if the yield curve is right that something's coming, might rhyme with those, but it'll have its own lyrics. Maybe it's debt piled up in places we're not paying attention to. Maybe it's governments struggling with the cost of higher interest payments. Maybe it's corporate zombies that only survived when money was free. Maybe it's something we're not even thinking about yet. But here's the part I really want you to take away from this video. The yield curve is one of the very few indicators that doesn't care about the narrative, doesn't care about elections, doesn't care about marketing. It's just the raw, revealed preference of the people moving trillions of dollars around. When they quietly accept lower returns for long-term safety while demanding higher returns for short-term risk, that's not noise, that's information. That's fear leaking out through interest rates. So when you hear people throw around dates like 1929, 2008, and 2026 in the same sentence, don't just hear scare tactic, hear pattern recognition. You don't have to agree with the conclusions, but at least respect the signal. Ask yourself, what would I do differently in my own life if I knew there was a higher probability, not certainty, just probability of a rough economic patch a year or two from now? Would I take on less risky debt? Build a bit more of a cushion, be a little more careful about assuming the good times roll forever? Those are boring questions. But they're also the ones that decide who gets wrecked and who just gets mildly inconvenienced. Because in the end, this isn't really a story about bonds. It's a story about time, fear, and denial. In 1929, we denied that the party could end. In 2008, we denied that the system could break. In the 2020s, we might be denying that the price of money itself has consequences. The yield curve doesn't argue, it doesn't shout, it just bends. And every time it bends the wrong way and stays there, history starts humming that same uneasy melody in the background. You can pretend you don't hear it, or you can be the person in the room who does. So the next time you see that headline about the yield curve inverting, or some analyst mentioning it in passing, remember this conversation. Remember 1929, remember 2008, and remember that somewhere, a future version of you is going to look back on what you did when the warning light was on. Did you shrug and say, "They always say that"? Or did you quietly, calmly adjust your life so that if 2026 does decide to join the list of infamous years, you're watching it from a position of strength instead of shock? That's the real question. Not, will 2026 be the next 2008, but when the pattern shows up again, who do you want to be in the story?